gonna quickly talk about the big beautiful bill and how it affects real estate investors, property owners, and those who want to be property owners, home buyers. All right. So there's good news for investors, property owners, and home buyers. You get to keep more of your rental income through QBI deductions. QBI, qualified business income. Now, before you even push on, let's just see what qualifies as qualified business income. QBI includes income from a trade or business you actively run, not a salary. Here's what often qualifies: rental property income, if managed like a business; self-employment income, such as realtors, contractors, and consultants; LLC partnership income, flipping houses if it's your business, not a one-time sale; property management income; short-term rental income, such as Airbnb, short-term rentals, that is if you materially participate. And what doesn't qualify as that are W-2 incomes from a job, stock dividends, interest income, capital gains from investments, unless they are structured as a business. Okay, moving on. So, you get to keep more of your QBI. If you own rental property or run it like a real estate business, the government lets you keep more of your profits instead of paying taxes on all of it. You used to get a 20% tax break. Now it's going to be going up to 23% starting in 2026, and it's permanent. For example, if you make $100K from rentals, you may only get taxed on 77 of that. That's more money in your pocket. And for those who qualify, or you have to make under 75K a year if you're single, or 150K if you're married, to get the full benefit. If you make more, the benefit slowly phases out. And you can deduct big renovation costs all at once. I believe this is called like bonus depreciation. So if you renovate a rental property or upgrade a property, you don't have to write off the costs slowly over years. Now you can deduct 100% of the cost immediately. So you pay less in taxes the same year you improve the property. Example, you spend $25K fixing up a unit, that comes right off your taxable income that year. So for the property owners, especially the ones, that are making upgrades, that are renovating their properties, make sure you keep your receipts. Go talk to your accountant, go talk to the people that do your taxes. Ask about this. Higher SALT cap. SALT, what is that? State and local taxes. So higher SALT cap equals more tax write-offs for some homeowners. People in higher tax states can now deduct more of their state and local taxes, or SALT, from their federal taxes, up to $40,000 for most families. If you make under 500K, that is. And this will last for 5 years. Mortgage interest on homes is still deductible up to $750K, which helps buyers in expensive markets. More help for investors in rural or underdeveloped areas, what is called opportunity zones. If you invest in places the government calls opportunity zones, you can pay less tax on the profits you make. These zones now include more rural areas starting in 2026. And if you keep your investment long enough, you can avoid paying some taxes completely. Okay, estate tax is less of a worry for wealthy families. The amount of money you can pass to your kids without estate tax is now higher. $50 million per person or $30 million per couple starting in 2026. So, all you trust fund babies, there you go. Some downsides to be aware of: less government help for tenants. There are no rules that cut back help for some people who use Medicaid or SNAP food stamps. that may mean some renters have a harder time affording rent, especially in lower income neighborhoods. So fewer tax breaks for solar or green real estate. Some clean energy tax credits like solar panels or efficient upgrades are being reduced or phased out. So you might not save as much if you go green as you might think. National debt, possible higher mortgage rates later. So the bill increases the national debt, I believe, by trillions. That could make borrowing more expensive down the road, including higher interest rates on mortgages, and real estate loans. Summary: who you are, what you get, what to watch out for. Rental property owners. What you get: bigger tax deductions, bonus write-offs, permanent QBI, qualified business income benefits. What to watch out for: tenants may struggle to pay rent if programs are cut. You see, like, rental property owners might suffer because of that, or they might not. It's all on how you see it. Home buyers. What you get: higher tax deductions, mortgage interest rates still deductible, but you may lose solar/green energy credits. Again, that's besides the point. Buy correctly, invest in the right areas, work with the right people just to get into a place that you can actually afford and to be able to tap in onto all the benefits that real estate has to offer. High net worth families, bigger estate and gift tax exemptions. Some deductions only last 5 years is what they have to watch out for. What counts as QBI? We already talked about that. So for the final thoughts, the bill gives real estate owners and investors big tax advantages, especially if you're renting out property, renovating, or investing in the right areas. But there are some risks, especially if government support for renters goes away or if mortgage rates rise. Want to see how this affects your real estate strategy? I can help you figure it out. No pressure, just information. You could DM me, call me, whatever. Just follow for more tips.